So India is one of the few countries that gives you access to long-term structural growth, thanks to its demographic dividend, a population that's becoming younger over time, which acts as a very strong structural tailwind to growth prospects there. Only recently the IMF actually upgraded India's growth estimates and is expecting a 2020 GDP growth rate of 7.7%, which is a full 1% higher than 3 years ago. And finally, on the market side, India actually gives you access to companies that have basically some of the highest returns compared to emerging markets. So the fund has a very, very clear investment philosophy and process. We consider ourselves to be quality investors. Everyone defines quality in a different way. We look at sustainable returns and how long-term those returns might be. But really important for us is that we also look at the integrity of management. Corporate governance is very important across all emerging markets, and that's also the case in India. So quality is one plank of our investment philosophy, but the other side is intrinsic value. We will never buy a stock unless we see there is a decent amount of upside and that we're comfortable on valuations. So it's quality and intrinsic value. The other side of the equation as well is just conviction. So we have a phrase for it: we don't believe in diversification. So we take very, very high conviction positions. Our portfolio will typically have between 25 and 30 names at any time. And in terms of really the types of characteristics you should expect going forward, we are very long-term investment professionals. So many people will say that they're long-term. If you look at our turnover, it's been 20 to 30%, so we do tend to hold our positions for long periods of time. Because we have a very, very strong quality bias, but we're also taking into account valuation, this is a portfolio that over time has given you access to the upside of the Indian market, but also given us strong downside protection. So those are the characteristics that you should expect going forward. So a couple of reasons why the Indian market has underperformed the rest of emerging markets over the last year. The first reason we would say is after we had demonetization at the end of 2016, that really pushed valuations up into 2017, and some of that valuation premium has actually just been kind of seeping out of the market gradually. So that's one reason. The second reason has been just question marks around the current account deficit, which is linked to oil. So India is an oil importing country. As the oil price has gone up, that's actually had a negative impact on the current account. However, in terms of where we think that is going forward, we find that our view is that oil is actually range bound now and is more likely. So on that point in the current account deficit, that's been linked to oil. And so we see that oil is in a much more benign situation now than it was this time last year. And the other reason for India underperforming has just been election uncertainty. Markets typically don't tend to like election uncertainty, and the Modi government in particular has had a series of election setbacks in the state elections at the end of last year, which caused some jitters in the market. So in terms of where we see that going forward, on the current account deficit, we think that actually was somewhat overdone, and we think that in fact the rupee, for example, should be appreciating this year. We also have a much more benign environment for interest rates. I remember this time last year, markets were very, very concerned about the Fed being overly hawkish. We think that's actually now turned, and I think all the signals that we're seeing from the Fed is that it's certainly a lot less hawkish than it was. And in terms of the election uncertainty, clearly, one never knows what will happen, but we are seeing more positive signs that the government is taking those election setbacks a bit more seriously and is spending more time and energy trying to woo the rural voter base, which is very, very important. So I think, notwithstanding any really negative political setbacks in the run-up to the election, we remain very positive on Indian equities. Valuations are a lot more attractive than they were a year ago. We're less concerned about the current account deficit. Question marks around the budget deficit are, we feel, already in the price. and we're more relaxed about the oil situation as well. So short term, we remain on a wait and see mode, but still towards the positive side. When it comes to the long-term appreciation potential for India, given that India is expected to have among the highest GDP growth rates across all emerging countries, 7.7% is what the IMF is expecting for 2020. In our view, that bodes very, very well for Indian equities. And India is also a market that can give you access to incredibly high-quality compounding stocks that should outperform over the long term. So I think the combination of having strong growth, structural reforms as well that are taking place in the country, and also very high-quality companies with incredibly strong return profiles bodes very, very well for the Indian markets. Putting the India and Pakistan conflict into the context of just purely the market, so the friction between India and Pakistan has been around for some time now. There are occasional flare-ups in the levels of friction, and obviously the market doesn't really like uncertainty, let alone any kind of military conflicts which we've seen recently. However, I think that neither country has any desire really to inflame tensions any further, and all the action that we have seen actually has been very swiftly dialed down. That also may be due to the fact of really countries being very aware of just how expensive wars are, and I think that's been a constraining factor. So our view is that these kind of issues will flare up over time. In most instances, the effort is really just to dial down the inflammatory talk, and we would expect that to be the case here as well.